Hey everyone, and welcome back to another video for today. So as you can see, seems like nothing can stop this bull market. Greens across the board unless you are an oil company, because oil is down today. But today, Alphabet is up 1%, Meta is up 1.4%, AMD up another 4% today. So in today's video, I do want to touch on a lot of analyst commentary for various companies, such as Meta. We have PayPal commentary, Circle, even Alphabet gets some commentary, and then more talks here about Mastercard, Fiserv, and stablecoins. Uber is up a decent amount today on a Volkswagen and Waymo announcement, and it seems like Google's AI model is still going to be the best currently, according to the betting markets. So I want to touch on all of that in this video, plus we're going to dive a little bit deeper into Lululemon, LVMH, and Nike. Nike will report earnings Thursday after the market closes. Hope you keep watching. If not, leave a comment and a like, and especially subscribe to this channel. Really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And also a special thanks to FinChat for sponsoring this video. So first up, we have here Citi reiterating buy on Meta and raises the price target to $803 from $690. They're saying product super cycle compounds across AI products and ads monetization. After spending time at Meta Beach in Cannes, talking with several brands, agencies, and marketers, and given multiple product announcements, we are incrementally positive on top pick Meta, and we are raising our projections and TP to $803. A consistent theme across our meetings as it relates to Meta was that it was among the best platform and target specific audience users find the variations to drive conversions and the platform doing so across formats. These investments have resulted in a significant ramp in ad spend and the platform, with one brand noting Meta strengthening creative offerings and video reels outperforming YouTube. So again, some very, very positive commentary here around Meta. Of course, more recently with Meta, what we've been hearing a lot is their investment in AI recruitment of AI talent. And so I think this is another big winner for the future. It has already been a big winner over the past couple of years, but I do think that the story will continue, especially if we go into the age of AR, VR, and all of that. Moving on to PayPal. We've talked a little bit about this during the live stream today. So Piper Sandler initiate coverage on PayPal with neutral rating, price target $74, which is basically the price that we're at right now. They say strategic pivot brings opportunity, but margin pressure likely. PayPal is currently in the midst of a strategic pivot with new management attempting to create monetizable omnichannel commerce hub for its 436 million plus accounts. We are cautiously optimistic on management's ability to execute on this large opportunity, but doing so will likely require significant investment spent in the coming years that we expect to weigh on margins. It's interesting because right now margins are getting better, yet revenue growth is slowing down, but I do expect that to flip around, especially with Braintree. Right now they're pricing into value, but there will come a time, I believe they said in the second half of this year, where Braintree growth is suddenly going to reaccelerate, and I think just the overall narrative around PayPal is going to change here as well. I still think that $74 here is extremely low for that company. Then a little bit more here on Circle. This thing just continues to go up and up and up. So Compass Point initiate coverage on Circle with neutral rating, price target $205. Cites long-term promise of stablecoins, but near-term risk and valuation concerns. Makes total sense. We believe stablecoins can disrupt the financial system as blockchains disintermediate banks and payment networks. A little more on the payment networks like Mastercard in just a bit. Circle provides pure play exposure to this disruptive technology as the largest issuer of regulated stablecoins. USDC's leading tech and liquidity provides long-term advantages. However, distribution is also a key driver of stablecoin market share, while Circle's current distribution partner are large players in crypto. Mainstream businesses have much broader connectivity to end users. With Circle trading at around 100x EBITDA, it's clear investors aren't valuing the stock on near-term earnings. However, given the threat of new entrants and declining gross margins and rate cuts as well, they initiate with a neutral rating and a 205 price target, which is a bit lower than where we're at right now. Then Citi comes out with a note on Google. While our conversation suggests both search and YouTube remain a key part of most media buying plans, and we are raising our projections for the second quarter and beyond given positive checks and data points, almost every marketer and agency we spoke with highlighted the evolution of search among users. They continue on Google's AI offerings, AI Overviews, AI Mode, AI Max for Search, part of Google's Power Pack. Most advertisers were generally optimistic here, highlighting greater click-through rates and were positive on Gemini. Note new Gemini 2.5 flashlight were industry leading and could benefit ad creative and the evolution toward keywordless targeting, moving beyond keywords, moving beyond SEOs. I'll skip some of the other things here. They said that YouTube is watched for over 1 billion hours daily on TV screens and remains the market leader with 12.5% share of US total viewing time. They were impressed to hear that YouTube Shorts now has over 200 billion daily views versus 70 billion at Google's last update, which was almost 2 years ago. VO3 is launching for YouTube Shorts this summer. This is very, very cool. And auto-dubbing across 9 languages is live. YouTube has already dubbed over 20 million videos over the past 6 months. So what they say here is the following. The net result here is they are raising their 2025 estimates and 26 revenue by 1.3% and 2.1% respectively. And while their target of fiscal 26 estimate GAAP EPS goes up by 1.3% to $10.24, they maintain their 20 times 2026 PE valuation methodology, moving their price target to, $203 from $200 prior. So a lot of explanation for a $3 increase. Moving on to Mastercard and Fiserv. So Mastercard is teaming up with Fiserv to roll out basically their own stablecoin. So the new stablecoin for Fiserv across Mastercard's global network. The move will let consumers and businesses use the stablecoin with over 150 million merchants worldwide. They'll also explore ways to help users move between fiat and FIUSD, settle transactions in the token, issue stablecoin linked cards, and tap into Mastercard's multi-token network. Both companies say this is about bringing stablecoins into everyday use, right? This is basically what the other analyst has said about Circle. And well, we've seen pressure on Mastercards and on Visa stock more recently because, well, the market was waiting. What about you and the stablecoins? And this is the news that we get right now. I am just very curious how this will affect Fiserv because the stock has been under pressure for quite a while. So I'm interested if somebody knows more information about that company, if you hold it, if you've been following it, let me know down in the comment section below. Moving on to Volkswagen and Uber here. So Volkswagen unveils their robotaxi designed for Uber Los Angeles fleet, and the first 500 will be delivered next year. So this is basically it. Got 13 cameras, 9 LiDARs, and 5 radars. Now you're going to say, oh, but it's more expensive than Tesla. Yeah, of course it is. But again, they are selling you a service. Same with Waymo. Waymo is not selling you the car, it's selling you the service. This is also a van that is selling you a service, right? And that's the whole thing. All of them will want to sell you that service, in my opinion, through the Uber platform. And that's how Uber is going to win here. Talking about Waymo and Uber, there is an announcement here. Atlanta Waymo is now available to all only on Uber. So this is the geofence area in Atlanta. I would assume that this is definitely where the majority of the rides happen through the Uber network anyways. So that's why Waymo is now available there. So you can toggle this on, get more Waymo rides. So again, Waymo is available in Atlanta only through Uber. Last thing here before we actually look at the 3 companies, which company has the best AI model of 2025? As of right now, it's quite clear. Gemini leading the pack here, close to 60%, OpenAI at 16%, xAI at 15%, and Anthropic at 6%. Of course, this is on Pony Market, things can change, but it does seem like the disrespect around Google and Gemini continues, which could be an advantage to us long-term shareholders. Moving on to the first stock, which is Lululemon. I'll first start here with a comment from Cohen. Stock is oversold. Management is confident in the scale of innovation in women's into fall and holiday, markdowns, inventory composition, and ability to mitigate current tariffs on EBIT margin in fiscal 26. At 16 times fiscal 20, I would assume fiscal 26 EPS and 20x free cash flow, shares are oversold by rating price target $321. So let's actually have a look here on fiscal.ai. Right now, the stock is experiencing a drawdown of 55% since its peaks, trading at $225, market cap $27 billion, trailing PE 15.4 times, forward one about the same, and the average analyst price target sits at $301. Right now, as you can see, revenue CAGR over the last 3 years was 17.4%. Forward 2 years, only 6.6%. So you're already seeing here a bit of the issue. And EPS only expected to grow 3.6%. Now, if we go and have a look at what the management has told us last quarter about the future of the business, little commentary here on inventory buildup. So the substantial increase on inventory, up 23%, raises questions about demand forecasting and inventory management. While the company states unit inventories increased 16%, a large inventory buildup could lead to future margin pressure if the company needs to discount products to clear excess stock. It also repurchases more shares for them. As for guidance, for the second quarter, the company expects net revenue to be in the range of $2.53 to $2.56 billion, representing 7 to 8% growth. For the full year, they're expecting growth of 5 to 7% or 7 to 8% excluding the 53rd week of 2024. Now, of course, all of this is available to you on fiscal.ai. Now, what is the market actually telling us or expecting this company to do when it comes to free cash flow for the upcoming fiscal years? So we can actually have a look here. We just drag this to the upcoming fiscal years. And we see the following thing. Currently, last 12 months, free cash flow down 24%. For the fiscal 26 years, that's expected to be down 19.4%. But then an acceleration, 21.9% growth in fiscal 27, and then just 2.5% year-over-year growth in fiscal 2028. Looking at some other interesting metrics here. So forward PE, 15.2, 15.3 times, but that's of course much lower than the close to 10-year average, which was 34.3 times. But of course, look at this huge spike here back during the biggest bubble, right, back in 2021. So yeah, it is of course much cheaper than the average, but I also think that since it is not expected to grow as fast as previously, it should not be trading at such a high multiple anymore. Same with the trailing PE, right? 15.3 times here again, 15.2, also much lower than the average. But then again, it shouldn't be trading so high either. What has happened previously, right? We look at the stock price and we look at net income. As you can see, a couple of times the stock just ran up way too much compared to net income. Right now, as you can see, net income did continue to go up, but we have a little disconnect. The stock price is coming down because, well, by the way, this is in the last 12 months, because maybe the market is now anticipating net income to come down actually a little bit. So always quite interesting to see the pattern right here. If we look at operating margin, still doing much better than before, right? We're at 23.4% right now. We were a little bit higher before, but we're still higher than in 2019, 2018. So operating margin wise for the business, I think is still fine. Free cash flow margin has, of course, been declining more recently. If we look at the last 12 months performance, that has been declining a little bit, while gross profit margin is still doing very well. Of course, if inventory builds up continue, they have to discount. Of course, margins there will get hit. But this is definitely, especially if we look at retail, this is a company that is definitely having much higher margins than its peers. Then looking at the growth rates, yeah, China business is growing faster than Americas, for sure. Rest of the world as well. So that's where you will see your better growth. But their biggest market is still Americas. And then women's product is the biggest segment here. Men's business was growing previously much faster than we are right now. So that's also a segment where previously there was some excitement around it. But right now the growth rates there, last quarter, just 7.7% growth. So With Lululemon, I guess it is a case of, yes, it is cheap right now compared to its average. Management still doing a good job. The business is still doing okay, all things considered. But is it exciting? Is it an exciting opportunity? I don't know. You tell me. Moving on to the next one, and that's Nike. Nike is now trading basically at $60. It's experiencing a over 50% drawdown here as well. Over the past 3 years, it's a company worth close to $90 billion, trailing PE of 19.8 times, but the forward one sits much higher at 38.5 times. Average analyst price target sits at $72.50. Revenue-wise, right, this has not grown anything basically over the last 3 years. It's expected to actually decline in the upcoming years as well. Same with EPS. This is definitely a business that is struggling, a business that is going through huge restructurings, right? We've heard that in the past from management, from the new CEO coming in, laying down his plans. He already prepared us, right? There's a strategic shift, there's a marketplace cleanup. He already prepared us for the upcoming quarter, which is going to be the report on Thursday after the market close. So Nike expects Q4 revenues to be down in the mid-teen range, including unfavorable shipment timings in North America and negative impact from the foreign exchange headwinds. Q4 gross margins are expected to be down approximately 400 to 500 basis points compared to the prior year. This is including restructuring charges, of course. So yeah, don't expect Q4 to be a good quarter. It's all about what the commentary is going to be on the earnings call. Now, again, you can all look at this on fiscal.ai, previously FinChat. Link is down in the description. You get 15% off, and new users will get 2 weeks of the pro version for free. This was previously FinChat, now just a rebrand towards fiscal.ai, probably the best stock research platform out there. So what is the market expecting Nike to do when it comes to free cash flow? And as you can see, it's not a pretty picture. As of right now, it's not a pretty picture. Free cash flow is still expected to decline. We're only going to see growth in free cash flow in fiscal 2027 by 13.1%. Now that said, Jeffries here reiterates a buy rating on Nike, price target $115. He says fiscal Q4 results will be painful, but long-term setup improving across product, traffic, and partnerships. The results will be painful. Last quarter, management threw out the kitchen sink, guiding revenue down in the teens and gross margin down 400 to 500 basis points. As Nike works through excess inventory, demand creation spend should stay elevated as the company invests in storytelling and brand marketing. We model EBIT margins down 1,050 basis points and EPS down 85% year over year, setting the stage for a reset. So right now, of course, when you look at the trading PE, yeah, of course, it looks cheap compared to its average, but it wasn't a struggling business previously like it is right now. If you look at the forward one, it's a very, very expensive. Very, very expensive because, well, EPS is coming down, margins is coming down as well. Overall, over the last 10 years, you can see gross profit margin right now have grown a little bit, but not by much. More recently, it has come down and is expected to come down even more. Same here with the free cash flow margin. And here as well, if you look at net income compared to the stock price, here stock peaked when net income peaked. And then when net income started to drop already back in 2022, you can see that the stock was already making its way down, down, down. And so yes, maybe when net income will start to go back up, we might see the stock react accordingly. Operating margin wise, of course, we are much lower than where we were here at the peak of the pandemic, 16.2%. We're now at 10.4%, very, very low for a company like Nike. Overall, the business can be cut into a couple of business segments. Footwear, which is the largest chunk, which has been decreasing now for the last couple of quarters. Then we've got apparel, equipment, global brand, Converse, and corporate. Of course, as you can see, this is not painting a beautiful picture right now. And the last thing here is, of course, total EBIT, right? The profitability side here comes down quite drastically. It has been coming down for a long, long time. And now, of course, with all of the restructurings, well, expect that to continue. But like the analyst said, this is setting up the stage for a nice reset. And so what do you think about Nike? Worth the price, not worth the price, worth waiting? Let me know down in the comment section below. Moving on to the last company, and that's LVMH. Here we can see, of course, you can buy it in dollars, you can buy it in euros as well. The biggest company that we've covered today. So market cap 200 and let's call it $59 billion. Here we are experiencing a drawdown also closer to 50%. Trading PE closer to 18 times. Forward PE 99 times, so huge difference here as well. This is of course a business with high margins, not like Hermes. Hermes is still best in class, but this is again luxury retail, so of course high margin business. Over the past couple of years, revenue has grown around 10% or so, but in the next 2 years, only 1.1%. Of course, Hermes is best in class because Hermes really has that niche where no matter what the situation is macro-wise, they will still be doing okay. LVMH, since they, and I'll show you, they own various businesses, then macro does affect even a company like that. But since luxury is not going to go away, right? Luxury is not going to go away. Is this attractive right now? Under 20 times earnings forward, and actually, well, forward here is actually much better. I think there needed a little refresh on the website. We're now under 20 times forward PE right here. Is this attractive? Maybe. I mean, if you look at their businesses, they have wine spirits, fashion and leather goods, perfumes and cosmetics, watches and jewelry, and then selective retail. That's the green one right here. The biggest one is, of course, fashion and leather goods. Over the last 5 years or so, watches and jewelry actually performed the best. Then we have fashion and leather that's performing also okay on a compounded annual growth rate. But the rest here, wine and perfumes, not that much. Margin-wise, gross profit margin, free cash flow margin, it's been doing quite well over the last 10 years. Recently, yes, we have a small rebound here, free cash flow margin-wise. Then gross margin did come down a little bit. Here as well, stock price, net income. Net income comes down, stock price goes down. So yeah, these things usually follow each other. And then the last thing, and I guess this is one of the other reasons why, operating margin went from 26.4% to now 23.1%. Well, for 2024, this is a company that, just like many other European companies, report earnings twice a year, in the first half and in the second half. And so here as well, when you look at the summary for the last transcript, while the company demonstrated resilience, overall revenue declined, primarily driven by a slowdown in Asia, particularly due to the recycling of strong Chinese demand in Japan from the previous year. So key takeaways: Chinese demand shift, regional performance divergence, brand-specific dynamics, strategic initiatives. If we look at guidance here, they anticipate continued macroeconomic uncertainties and a lack of visibility on external factors. So I'd say here again, although it is a very strong company that is definitely trading at more attractive prices today than before, I guess you have time to make your decision, to see if there is a rebound, to see next time they report commentary around all of that. Although we've seen some signs coming out of China that, well, if you believe those numbers or not, that the Chinese economy is doing a little bit better than feared. So that could definitely help a company like LVMH. So all in all, that's about it for me in this video. If you enjoy this type of videos, hit all the buttons, especially the subscribe one, and I'll see you all in the next one. Bye-bye.